welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 162. On today's episode, Cameron and I are going to be breaking down the first quarter of 2025, which has not been fun. It has been a pretty volatile market, but we'll bring some optimism here as we look at some opportunities for your portfolio and how you can use that to improve your portfolio over the next coming year. So as always, get your mind right and let's get to work. Well, welcome back to the Investor Professor podcast. Cameron, welcome to the end of quarter number one.
Q1, baby.
I mean, we got a day left, but we limping into it.
Hopefully it's going to be, well, it's Friday, but yeah, hopefully we got a good one.
Yeah, we'll see. But it's been pretty rough. The NASDAQ's now down 10% for the year. S&P 500's down 5%, and Dow Jones is down 2%. So that's where we're at. All major averages in the negative.
Well, where's the silver lining here? Give me something.
You give me the silver lining. So next week we have reciprocal tariffs coming on, and we'll see what happens. I mean, Trump posted a thing that he had a conversation today with the Canadian Prime Minister, said that it went well. You know, maybe we'll get some relief on that. But otherwise, I mean, the big shock to the market this week was the tariffs on automobiles. So 25% on foreign or automobiles not made in the U.S., but also just the non-American parts.
Yeah. Which,
I mean, that is going to, you can say that, but actually the execution of that to figure out what was made. So, because we assemble a lot of cars here, but we don't necessarily build them. They bring in materials. So you think like GM, you're like, oh, GM's an American company. Mm-hmm. But then it's like, oh, actually, they actually import a lot of the components for their automobiles that are made somewhere else.
And they assemble. I mean, I don't even know how frequent it is for them to assemble it in here in America. Like the way I looked at it, because all these Rolls-Royce, they're moving a plant here. Mm-hmm. I know VW was talking about it, Audi. But you know who actually makes the cars here? There's one brand that you haven't seen a headline on. If you had to guess, what would it be? It's
Toyota.
A luxury brand.
Oh, luxury?
Yeah.
BMW?
Mercedes-Benz.
Mercedes in South Carolina?
They moved it over here a while ago.
Yeah, South Carolina.
And they have a big Atlanta hub, too.
Mm-hmm.
So they're the only ones that really aren't affected by this.
Tesla and Rivian, they build everything here.
That's true, too. Yeah.
Toyota does a lot with the we're in Texas, so they have the Tundra plant in San Antonio in different places. So it'll be interesting to see how that plays out. I mean, a lot of this stuff, you and I have had these conversations offline, but trying to keep up with tariffs, what's impacted, what's not. I mean, I think for me, looking forward, it's going to be consumer sentiment, and does all of this kind of all the talk about this, does it start to impact company numbers? So the big thing is we're obviously in a market correction, which is a correction is considered as a 10% drop, from the peak to the trough, right? So from where you start down is a 10%. It's considered a correction, which happens pretty regularly.
Yeah, it sounds worse than it is.
It does sound worse than it is, but on average, there's one about maybe every 18 months. So the average correction is about 16%. That's actually the average correction is about 16%. So we're not too far away from that. But also, so you look at a recession, and a recession is going to be much, if you have a mild recession, the average drawdown is 20 to 30%. If you have a severe recession with 2008, 2009, that is 40 to 50%. So the key for investors here is trying to figure out, is this just a normal correction? And should I be investing into some of these companies that have moved down a lot? Or is it something a little bit deeper that could end up being something that is like a recession? And I think that's going to be the key when you have earnings coming up in the next couple weeks at the end of April, is our company seeing a shift in consumers and the way they spend and things like that. And you're starting to see it some places like the airlines, where, American, Delta, that have said that, people aren't booking the summer vacations that they thought they were going to book. So to see if that goes through will be kind of key.
Yeah, I mean, that's probably a good question. Is where do you think the consumer's at right now? Like, obviously, I know they always talk about flights, like how much is being spent on airlines, which is
Right.
a good indicator. But I think there's better ones. But like, where do you think the consumer is right now? How do you think they feel?
I just think there's probably just an area of uncertainty where you
Yeah.
don't really know how things are going to go. And so, I mean, the decision there is like, I'm just going to wait and see, which is like, you're not really spending a whole lot of money. Like you're just kind of like waiting to see what happens. And does this stick? Does it not stick? I mean, that's kind of the key. I saw some reports. I don't know if these are true, but they said like some of these tariffs, like if they happen on automobiles, would increase the price of vehicles by an average of $4,000 to $5,000.
Yeah, so the first one to do that was Ferrari. I don't know if you saw that. They're increasing all their pricing by 10%.
Oh, okay. Well, that's going to impact you.
Yeah. Well, I think they were quick because they know their consumer base really isn't that's not gonna affect anything.
Yeah.
I mean, because it's such a high priced car.
Cameron's got a birthday coming up. I think he was going to buy himself a Ferrari for his birthday.
How'd you know? Yep, I'm in line. The one thing about the consumer that I think is interesting, and there's been a lot of news on this, was the new Klarna and DoorDash partnership. So now you can DoorDash your meals, and you could do 4 payments on your Chipotle burrito for $10. So I look at that and I think, okay, if I'm DoorDash,
Is that
100%? Yeah.
Okay,
But
right.
okay, so let's like break this down though. So who's the one that's making this move? Like Klarna is going to want to do business with anybody. It's DoorDash. It's going to be the one that has to say yes for a partnership like this, right?
Right. Yeah.
So DoorDash, they want to make it as convenient as possible to bring more revenue in the door. But they also don't want to invest in areas, especially where they are now. They don't want to invest in areas that they don't think is going to be worth their time. So they had to have done some kind of, data analysis or looked at it and said, okay, if we did this as an option, we would actually be better. Like the cost for us to make this partnership happen is going to be there, but there will be an ROI on our time. That has me looking at it being a little I kind of am a little worried about that.
Yeah. Like I'm still paying off the burrito I ate last Wednesday.
Why? Like, what is it? Are people really wanting that much flexibility that they're like, okay, well, I just don't want this 10 coming out of my, bank account today. I want to break it up. Can we do 3 payments?
Yeah. I mean, like infomercialing food is, I don't know that one. I did see that headline. I just thought surely not like, but you'll notice like, Visa, MasterCard, American Express. I mean, you notice like one of the one of the things you look for is like, are people putting everyday items like gas and groceries and just like that stuff is the stuff that's like building up on their credit cards. And I mean, for some people, especially, lower income type consumers, I mean, that is a big deal.
Yeah. I mean, consumer debt is rising, but I don't know. I think there's some, I mean, if we want to talk about positive, think about like the attitude of the market right now. IPOs are coming back. There's already talks of that, right? We had CoreWeave today.
Yeah, a little bit.
It's slow. There's no way it would be like the floodgates would open.
Right.
You got this is the way I view it. I look at it as a picture. Everybody, all the companies, all the CEOs are at the starting line. And they're looking left and looking right and saying,
who's going to go?
Who's going to go first? Somebody do it so we can kind of test the waters.
Yeah, test it out.
And CoreWeave was today, right? I think they ended in the green, so just barely up.
I think so. So let's tell people what CoreWeave does.
Go for it.
Oh, look at you.
Are you trying to set me up?
Yeah, I was trying to set you up. I was trying to see if you knew. So CoreWeave, where'd they IPO at? I'm trying to
40.
pull it up. 40.
So I'll give you some context on CoreWeave just real quick.
But they finished flat actually.
So this is the interesting about CoreWeave. And I think they were in a very tough spot because they are the first real one to catch some attention, A. B, they're coming out in a time where people are like, hey, this AI stuff's good. We're investing in it. But like, show me something.
Yeah, they're still skeptical. There's still a lot of skepticism. Yeah.
Tough market. And the fact that they're flat, I think is not a bad. I think it's a good sign.
Yeah.
But the one thing that I did read going into this is the CEO, they were pricing this, and you could probably go into this how they price this stuff, but they were pricing this at like $45 a share is what their IPO offering. With the price they were going to start offering.
Yeah, that's what Morgan Stanley I think is the lead underwriter. But CoreWeave, aren't they data centers?
Yeah. So they own the chips, I think, and then they rent it out.
Yeah, I mean, and they have a lot of pretty big customers.
Or the hardware. They own the hardware and they rent it out.
Yeah, I think they have some pretty big customers on that. But I know that Nvidia is a big. I know Nvidia is a big investor in them.
Yes.
And I know that when like there wasn't as much interest, so when they go and they, the big investment bankers, they go around, they do what's called book building, where they go out and they ask people, are you interested in this? Are you interested in the company?
What do they call that?
Book building.
Oh, book building?
Yeah, so they go around and they ask people, are you interested in this? And they said yes, and then the market doesn't do so well. They said, man, we're not really interested at 45. Okay, well, what price would you be interested in? And I know Nvidia is a big investor in them, and so I know that they put like more money into them, I believe, to kind of keep that price up.
They did. So they were one of the first main backers. So plain English, they lease out the access to these AI chips. Okay. Super simple. That's what they do. They have 14 data centers, and they're planning on having 28. So they want to double by the end of the year, that's kind of ambitious. Mm-hmm. But they are they're leasing out this space. The one thing about CoreWeave that I think is interesting, though, is that they started out as like a Bitcoin mining company.
I guess what do the young kids
say?
They
reorganized.
They pivoted.
Yeah, they pivoted. They pivoted their total business plan.
And one of their big customers is Microsoft, which if Microsoft decides to tone down how many data centers they want, that would impact CoreWeave. I mean, so there's a lot of the because AI is so new and all this, there's a lot of it's just kind of, they're all woven together a little bit,
Yeah.
So we'll see, we'll see if that, how that goes. But it's a big test for the AI market, and not just the AI market, but the IPO market, to see how that goes. So we'll see. I think, there is so much negativity in the market right now that you do have to look for, okay, where are some bits of optimism?
Yeah.
And so one of the things I look at is, we talk about what's a correction, how much companies have gone down. So 10%, again, is a correction. 20% would be considered a bear market if a company drops that much. And so you look at somebody like Nvidia, who their high for the year is 149. They closed today around 110. I mean, that's already a drop of 26%. So at some point, you have to think to yourself, like, when am I going to invest in some of the companies that I wish I would have invested in, or I wish I would have invested more in? Like, what number do they have to get to for you to start investing? And I think about like active money managers, professional money managers. They know these statistics. They know that the correction's 10%. They know the average correction's 16%. They know that a bear market's 20%. And you start seeing how Amazon's down 20% from their highs, from $240 a share. Today they're somewhere around 192, 193. And that's a pretty good spot. Like if you didn't have enough or weren't invested as much in Amazon as you wanted to be, I mean, at some point you have to be willing to invest. But the key is as we always do, like just human nature is, can I get it a little bit cheaper?
Yeah. Everybody wants a good deal.
Everybody wants a better deal. And I can't tell you, like, when I was younger, how many times I would be like, all right, when it gets to this level, I'll start buying it. And it would get right above it, and it would turn back the other way. And I finally had to come up with a point where it's like, okay, I'm just got to, at this level, I'm going to buy some shares. If it goes lower, I'll buy a little bit more. Like, cause I just missed so many times.
I think that's one of those things too, where a lot of this, when you're trying to win in the market, right? Oftentimes it's not black and white. There's a balance, right? And it's not so much a price target of this, and then I start just scooping up. It's at this price, I buy a little bit. At this price, I buy a little bit more than I did before. At this price, now I'm actually going to start scooping up, right? So you're kind of, and it also spreads your risk out when you do it that way.
Yeah. Well, and it gives you the opportunity to not, like, if you're buying these huge purchases, I mean, you got to be right, and so you give yourself no room for error.
Exactly.
And you feel, one day you feel smart, one day you feel dumb. I mean, and again, I mean, we bring up like loss aversion, which is that investors are twice as impacted by a loss as they are a gain. Mm-hmm. And so even though we had 2 really good years back to back, I mean, you have one bad quarter and, you start looking at things differently. And so you just kind of got to go against the grain a little bit. And I think about that too. outperform the market, to invest and have performance that's different from other people, you got to do things a little bit differently. So when the market sells off on a day like today, I mean, you got to be willing to invest a little bit. And then on a day like Tuesday, when everybody was excited and euphoric because Trump said he'd be flexible on tariffs, and the market rallied, you got to be willing to trim some. And I mean, especially if we have a market that just goes sideways.
Yeah. And there's some human psychology there where like anytime you're going to make a decision, you often think you think of the previous worst times and not the previous best times. Like I bet you 2 weeks from now, people are more likely going to remember today than they remembered. Was it Tuesday when Trump said he's going to be flexible? And we had a great day.
You're right.
People aren't going to remember that as much as they do today, I think, closing on a Friday in the red.
Yeah, for sure. I mean, well, but today too. So, today's in the red, but it's also like options expiration into the quarter.
So it's market behavior
there's
is really
a lot of
dictating
stuff that goes into this. And I noticed like so many stocks today, like I did invest in like Amazon today, was one that I invested in. And some of them, Amazon was on higher volume, but I noticed like there was a lot of stocks that like actually they were down on low volume. Like even NVIDIA, I mean, on average, 278 million shares traded a day. Today, only 227 traded.
Do you think that's lack of institution or lack of retail?
I would say it'd be more lack of institution.
That's what my guess would be.
Yeah.
Real quick, because we skipped over it. You mentioned the options expiration today. For the people that don't know, how does that? Do you mind sharing a little bit how that affects the market? So, like there's the double witching hour, the triple witching hour, where it's like these option contracts are expiring, right? And those options need to be fulfilled, whether they were fulfilled by the buyer or the seller, right? So that's going to be the market.
Or if they just expire worthless. So
that's true too.
So the thing about the options is they always have an expiration date.
Yep.
And around the end of the quarters, when I don't know, I don't have it down in my memory like the triple with because there's some that like
it's a duration, depends on the duration.
The duration on when they kind of all there's certain times of the year where like all these options kind of come together at the same time. They all expire at the same time. But normally, like the last Friday of the month is usually one.
Yeah.
It has been, like, I will say this, the behavior on options has been a little bit different because places like Robinhood have started doing like 0-day options.
Yeah.
That are basically just, I mean, those are straight up lottery tickets.
Yeah.
I mean, to me, they are.
I agreed.
I mean, like if you're just doing an option for a day. But yeah, so if you have a call option, which is you think the stock's going to go up, or you have a put option where you think the stock's going to go down, if somebody has sold those, I mean, there's going to be a time period where they're going to expire, and so that takes a lot of volume out of the market unless they roll it over or unless they resell it.
The markets are a voting machine, and options are part of it. So like a 0-day option, meaning that you're buying an option contract in the morning and it's going to expire that day.
Right.
So that's what you mean by lottery ticket, because now you're not just betting on the performance of a position, you're betting on the performance of the position being done within the trading hours.
The next 8 hours.
Yeah, which is not a lot of room for error.
No, you're hoping you get to I don't know. I don't know why you would do. I mean, I don't know really. I mean, you're just trying to take advantage of the day's option, But again, I mean, there will be some selling. I mean, I'm sure that, they're selling the call options and things like that to generate income into portfolios and things like that. So I've never been like, I've told you this, like I've done options in the past, but I've always been like 50-50. I'm sure I'm either 50-50 or negative. I mean, like I just haven't really.
Yeah. There really isn't a need to. I mean, unless I can kind of get it if you're managing a big book and you're trying to hedge a little bit, potentially.
If you have a big position and you're trying to hedge it, you just want to hedge it. Yeah.
Yeah. So that makes sense. But like to be full risk on of like, hey, I have, X amount of capital, I'm going to throw it all in options. I think that you're really dancing with fire.
Yeah. And then also too, I mean, I think that, it's a sophisticated thing, but there's some people that do it really well, but they concentrate on it. I mean, they have to, it's something you have to concentrate on.
But when people do it well, and we're kind of going in the rabbit hole right now, so, but when people do it well, it's not so much that the option itself, the option on the company, like performed well because the company performed well, it's usually because the option's mispriced. Correct me if I'm wrong, but usually it's because the option, for whatever reason, because of supply and demand, it's mispriced and you're taking advantage of that mispricing. But
yeah,
enough of that.
Yeah, I think I think that for most investors that aren't going to do something like that, I mean, this is one of those time periods where I think about episodes that I did in 2022, which was like sit on your hands and things like that. Like,
Yeah.
I don't mean to like say the same things over again, but it's like sometimes you do have to wait for there to be a little bit more clarity. And I think the hard part in today's market is feeling like you should be doing something all the time.
Do you think that's happened more recently today than previously?
Yes.
And
I actually think it's getting worse. I actually think it's getting worse.
So what's driving that?
All of the stuff we talked about, like you can trade on your cell phone.
Yeah, so accessibility.
You have accessibility. You also have no cost going in or out, right? So there's no commission. You're not paying commissions like you used to. It's easy to stop the pain by selling out or to do these 0-day options. There's so many different products out there, and so many investors don't realize that all these companies, they need you to trade because they're making micro profits on these transactions. They need you to have transactions. They need your trading volume to be up.
So they make it there, and then they also make it because they sell the transaction, the data of it, right?
Correct.
So it's like that. Also, it's a double whammy. They make more as you trade more.
I think over time it might become easier for this is hot sports opinion here, but buy and hold investors, to let everybody else basically churn it out, and fight it out on top. I think buy and hold investors will start to do better and better and better.
I could agree. The whole value investing, right?
Yeah, but I mean, but it goes back to that chart of if you miss the 10 best days in the last 2 years, you cut your performance in half. There are going to be so many investors who, because either they're not educated or they just don't know or they just can't stop from touching it. You're constantly trading your account. You're constantly next to your cost basis. You never get away from your cost basis. You never feel comfortable in the things that you own. It is such a practice of delayed gratification.
Yes, I agree.
I mean, because that compound effect happens everywhere in your life, whether it's reading, whether it's exercising, whether it's your investment account or the way you save money. It's like you worked with people enough to know that most people who have accumulated wealth, who have done well in the stock market or whatever, the other areas of their life are put together.
Yes, because it's the personality that drives a lot of the decision making.
Right.
And the personality being that you're willing to forego today for a better tomorrow.
Yeah, they had to have that discipline in so many areas of their life to make it happen.
Exactly. Yeah, I agree. I think we've talked about this before, but the whole thing with compound effect and dividend yield, right?
Yeah.
That as you repurchase shares, your dividend yield gets larger and larger. And the goal there really is that compound effect is it seems like it's not helping you right now, but it's a slow build. But when you get older and your dividend yield is 11, 12, 13, 14%, you're not going to be able to get that anywhere.
No.
But all because you made a decision a long time ago and you just dividend reinvested.
Yeah. Yeah. I mean, that's what, Buffett always says, somebody's sitting in the shade today because somebody planted a tree a long time ago. I mean, it's the same kind of deal,
Yeah,
I mean,
I like that.
It's the same thing, but that's what's hard when you do a podcast like we're doing and you have to talk about it's so hard not to talk out of both sides of your mouth because you got to talk about what's going on today, but then you have to think about, okay, but I'm thinking about what's going to happen 3 years from now, 10 years from now, that kind of thing. But it's hard not to think about the last 3 days. Mm-hmm. I mean, that there's always going to be something to worry about. And really, I mean, and that's, in these gray periods in between, I mean, it's hard to kind of be here in the middle.
Oh, I agree. Yeah. And you got that recency bias, like you just mentioned too. Cause volatility, you're kind of wondering, okay, I'm going to maybe purchase this cause I know it's a good company, but market's been up and down. Should I not purchase it? And then you start second guessing yourself when you should just stick to, like you said, discipline. Yeah. I tell my friends, you get paid on a Friday, right? pay your bills off, because that's the first thing.
Right.
You know, get yourself into a good spot. And then Monday or Tuesday comes around, then, you know, whatever money you had budgeted left over, take that and just know, hey, I'm going to buy the S&P.
Right.
I'm going to dollar cost average into it. Or I'm going to
Yeah.
buy, you know, say you're big on Amazon. I'm going to buy Amazon, whatever it is. But just having that routine and you're basing it off of when you get paid,
Yeah.
you're just creating the habit.
You're going to have to start telling them, like, make sure they pay their food off for the week.
Yeah, don't forget about that. And this is not financial advice, so talk to your financial advisors, but you just got to create something that you can do for a long period of time, and it's not going to be difficult to carry on.
Yeah, it's the consistency, and it's also just, you know, if you do need money, if somebody's older and they know they're going to need cash flow over the next year or so, I mean, you got to make sure that you take care of that cash flow need. And that, you know, and again, I think about like a barbell strategy where you have something like the AT&Ts, the Procter & Gambles, those kind of companies that have done well. I mean, if you look at the S&P,
AT&T's doing great.
You know, I mean, terrible stock over the last 5 years, but great stock over the last 5 months.
Yep.
But they're getting their debt taken care of, all these kind of things. So, you know, that barbell strategy. So you have those kind of stocks, and then you have the riskier stocks on the other side, and you kind of build a portfolio that way.
More than that, we talked to AT&T, I think, earlier in the week. But so yeah, they are getting they're reducing debt. But what else are they doing? You told me. AT&T.
The fiber.
They're getting back to their roots of just their business.
Yeah.
Right. So they're just focusing on what made them successful, and they're making it simple. And sometimes, like, that's what you got to do. Keep it simple.
Yeah, I mean, get back to what got them there. I mean, like, the fiber product is fantastic, and it's a profitable product for them, and I mean, it's done great. I mean, so them paying off their debt, getting more fiber customers. I mean, it makes AT&T look like a pretty good place to be. Their dividend's 3.84% at this level, and so you know.
Good. You knew that off the cuff, huh?
Yeah.
Not like you looked it up.
No, I didn't. But yeah, I mean, so but you have to look and see. I mean, it's like, man, that's a pretty good place to be. I mean, it's pretty close. I mean, you can do a CD for about 4.2% right now, but you're probably not going to get the growth that AT&T has. So,
and you're not going to get the dividend yield.
Yeah, and you won't get the yield. Yeah,
from the
over
compound,
time. Yeah,
from the compound effect.
So there's just those kind of things that investors have to think about. But again, the other thing I think that is so important to discuss is you have to set your life up in a way to where you have some extra money to invest. I mean, so this is one of those times where the market starts to not do so well. Like me personally, like I'm personally buying stuff. I bought more NVIDIA today, like myself, my personal portfolio. Like I bought some NVIDIA today. You know, that was a stock that years ago, I don't feel like I invested enough. And so I've been trying to use this as an opportunity to kind of get that position to where I wanted it to be. So, I mean, you have to be, but you also have to have some, I mean, you got to have some cash flow to be able to make that happen.
Yep. Speaking about NVIDIA, they had their big yearly conference last year.
Yes. Last
week. Sorry, last week. And if anybody wants to be inspired, go watch the first keynote speech where they started the conference off.
You just mean the commercial, right? Are you talking about the whole speech?
The whole speech is long, but the first 15 minutes, I guess, if you want to slim it up.
Right.
But like
that first video though.
Oh my gosh. Real quick, why they are where they are.
Yeah.
Like they, most companies, they'll, show the feature of whatever they're doing, whatever. And it's like, oh no, not NVIDIA. No, like we are predicting the tomorrow through data. And then you see a fire truck and then, a forest fire and all this stuff. And you have Jensen come out and he's like pumped up.
Yeah.
And he's got a few more zippers on that leather jacket. So, he's doing well.
Yeah. It's it is amazing. Like, I think that it's so easy for us to, like, it's so easy to get caught up in the negativity. Like it's like,
oh yeah,
it's like being a professor and getting a bad review.
Okay.
Just kidding. We'll come back to that.
Should we?
No.
Okay.
But it does happen. Like you have like good reviews, you get a bad review. You're like, man, you start thinking about, I did get a bad review. Probably one of the worst ones. I'll let Cameron read it. It's pretty rough.
I'll be a therapist today.
Yeah. So, but I mean, but you can't change everything just based on that. But it's the same thing when you look at companies. If you thought NVIDIA was a great company, they're going to change the world 6 months ago. It's the same. Like you watch that keynote, you watch that little, like that video that they posted, and you're just like, man, this is incredible. Like this is the future. Like do I want to be a part of that? Do I want to invest in that? So you have to look for those little pockets where it's like, man, this is when I think about like the money that, clients made the last 2 years. It was because of the decisions we made in 2022. So you always have to be thinking about what decision am I making now that's going to, probably going to be the investment that pays off in the next couple of years.
Yeah.
And I think that's, how you have to kind of judge it.
I agree. I mean, you kind of saw this. I mean, I wasn't invested at that time, the tech bubble in 2001.
Oh, yeah.
I was young, was fresh, 3 years old. But if I was around that time, I would have seen the market, and it was a .com crash. So everyone was doing all these internet websites, all this crazy stuff. Internet was successful, as we know today.
Mm-hmm.
But there was a few avenues that just kind of were a little crazy. But at the end of the day, the internet was successful. So it's like, how do you? I'm sure when did Palantir start? 2013.
Yeah.
Okay, so 2013. Nobody wanted to invest in Palantir in 2013 or 2014, 2015 because they were a little early and they stuck to what they knew and they were just focused on creating a great business.
Right.
I think about that today.
Yeah.
Right? Like, okay, yeah, NVIDIA, we have these, different apps that are being built off of these AI tools like Harvey, where it's, legal advice, whatever.
Mm-hmm.
What are the ones that are staying true and just focusing on the stuff today that are going to carry forward? You know what I mean? Like the next Palantir, I know that's tough to get, but
it is.
NVIDIA is selling the shovels, right?
Yeah. I mean, there's always going to be companies out there. I mean, like even like the tech bubble. I mean, you would have wished when it burst. I mean, you would have wished you would have bought PayPal. I mean, that was one. I mean, there's always going to be companies that are created out of those times.
Payments.
But one of the ones that's interesting, right? So year to date, you look tech. Nasdaq's down 10%. Uber is up 20% for the year.
Yeah.
Which is a odd one to me, because if you think the economy is going to slow down and you think that people aren't going to travel as much and do all this kind of stuff, why would Uber be up? Now, I will say that I know that Bill Ackman has published something. Is that right? Am I right there? Is it Bill Ackman that's been the one who's been buying it?
I think it is. Yeah.
Okay. So I know that he has been purchasing a lot of Uber.
It is.
But I just find
2.3 billion.
I just find that kind of interesting.
That is interesting. Uber's, I mean, solid company. My gosh, you think about how they're just ingrained in the just people's habits.
The habits. I'm telling you, come back to habits.
But here's the other thing too, and you can't buy this. The CEO of Uber, when he first started, what did he do for the first 6 months? Do you remember? I think we talked about it on the podcast.
Yeah, we did. He drove.
He drove 5 days a week. Find me another CEO that does that.
Yeah, no, I mean, that's the key.
You can't buy that.
Yeah. You can go read that Wall Street Journal article where he talked about it, and he did it without for the longest time. He did it without people knowing. That was the key. Is people didn't know he was doing it.
Yeah.
Even the other like C-suite,
they didn't know.
They didn't know the CF, and then he ended up making them drive. But he said he learned more about the company during those drives than anybody.
I think about the next board meeting they come into, the whole executive team there, and he announces, and everyone else is like, "Are we doing enough here? Are we doing enough? Like, should we be worried for our jobs?
Right.
That's where they all working us."
Yeah, but I mean, you get information and you get data that nobody else has, and that was a key. I mean, that when I read that article, that's literally when I invested.
That is what you look for.
Yeah,
and you can't teach that. I feel like you just got to have that innate.
That's that qualitative piece that is so hard to measure.
Oh my gosh, yes. But Uber, and their margins are great, and part of it, they have a great driver. They have a great driver base, and if you ask a driver, hey, which app do you like more? Oh, we like the app interface for Uber. It's a great user experience. Totally. Which one pays you more? Oh, Lyft pays you a little bit more. Uber takes more, and they have been increasing over time.
Right.
Which one do you use more? Uber. So it's like, okay, you're not making as much on Uber, but you don't really care because you know all the communities on Uber, and it's such an easier platform. So they're willing to make less money for the convenience that Uber provides. And that is a slow growth. You can't build that overnight. They did it, and they did it well.
No, and we've seen it many times where the habits, the consistency, and convenience. Humans will pay for convenience, both employees and consumers. So you see that, like when you just talked about, they'll they'll use Uber because of the convenience of the app and how much they can see and all those kind of things. So I don't know. We'll see what happens. I mean, first quarter a little bit rocky. Second quarter is going to be make or break. Second quarter is going to be make or break. I'm telling you, like if companies come out and talk about how like, there's changes in habits and all that kind of stuff, the market's going to have a hard time adjusting to that. Like we need to have some good earnings.
But I do agree with you. But long term, we're going to be okay.
Oh yeah.
So like if you think about quarter to quarter, yeah, there's going to be some fluctuation. But over time, you investing now, I don't think 15, 20 years from now, you're going to look back and be like, I shouldn't have invested those first 2 quarters of Trump's presidency because it was so crazy.
Well, we don't even have there's not a 20-year period where you would have lost money. So,
yeah,
you would have been, 20 years out. But that's a long time for most people to.
Well, I'm just saying, like,
right.
You think long term.
I even think 24 months. I think you'll be fine in 24 months. So we'll see what happens. So Cameron, I got 19 miles to run tomorrow. We've got 1 month till London.
Yep, we're gonna get it.
So let's go.
19.
All right. Anything else? You good?
That's good.
All right. Don't mistake activity for achievement, and we will see you next time. Thanks, everybody.